Hello everyone, I'm Ragini Mukundan, a Microsoft Dynamics 365 ERP functional consultant at Cetas. This series is about understanding COGS calculation in Microsoft Dynamics 365 Business Central. We will be breaking down how cost of goods sold or COGS is calculated in Business Central step by step in a simple and structured way. Whether you're in finance, operations, or just getting started with Business Central, this series will help you clearly understand where your costs come from and how the system calculates them. In this video, we will be covering why COGS calculation is simpler, more transparent and accurate in Microsoft Dynamics 365 Business Central compared to many other ERPs and accounting systems. We'll go step by step to understand what exactly is COGS in accounting system and how is COGS relevant. How COGS is calculated in other ERP systems. What's missing and how COGS is automatically calculated and posted in Business Central. What is COGS? In accounting terms, COGS or cost of goods sold represents the cost of inventory items that have been sold during a period. It is the cost incurred to generate sales revenue. So, how do we calculate COGS? On the right side, I have a format of a simple trading account that I had picked up online. If you see here on the left side of the account, we have the opening stock, net purchases, which is purchases minus purchase returns, and direct expenses. On the right side, we have the net sales, which is sales minus sales returns, and closing stock. To arrive at the gross profit and gross loss, which is indicated at the bottom of the trading account, we add up all the items on the left side of the account, which is my opening stock, net purchases, and direct expenses. Subtract the closing stock from this total, then subtract this result from the net sales to find the gross profit or gross loss. Within this process, COGS is what we have done from considering the opening stock, adding the net purchases and the direct expenses, and then subtracting the closing stock before deducting it from the net sales. So basically, opening stock plus net purchases and direct expenses minus closing stock is my cost of goods sold. Now coming to the second main question, how COGS is calculated in other ERPs. Tally and most smaller ERPs basically follow a periodic inventory system. That means it records purchases and sales normally. But inventory value and COGS are not updated automatically with every transaction. Instead, inventory is adjusted manually at the end of the accounting period, which could be a month or a year. I'll explain this further with an example. Let's say you buy goods worth ₹1,000 from a supplier. When you record a purchase voucher, this is the entry that will be created in the system, which is purchase account debit 1,000 to supplier account 1,000. So here there are a couple of observations we need to make. First, the purchase account is an expense account, which is a PL item. So the system treats it as if the goods are already consumed, even though they are still sitting in your warehouse. Second is that no inventory GL account is being hit in this transaction. If you have enabled maintain accounts with inventory and linked items, Tally will keep quantities updated in the stock module, but financially it is still treated as a PL expense and not an asset. So the balance sheet still doesn't show your inventory value correctly. Now, the sales process. You sell part of that inventory, say goods worth ₹600 for ₹700. The entry will be customer account debit 700 to sales account 700. Again, there is no automatic cost entry. Tally records revenue, but it doesn't reduce the inventory or record the cost yet. So after the sale, Your purchases account is debited by rupees 1000. Your sales account is credited by rupees 700. Your inventory in the stock module is reduced by quantity, but it is not reflected in the GL for rupees 600. This means your PL is currently wrong. It shows full rupees 1000 expense, but only rupees 700 revenue. So, at the end of the month or period, the accountant shall calculate COGS. COGS is opening stock plus purchases minus closing stock. In our example, our purchases is worth rupees 1000 and our closing stock, which is the unsold goods, amounts to rupees 400. So, purchases of rupees 1000, closing stock unsold goods of rupees 400, COGS is equal to 1000 minus 400, which is equal to rupees 600. After this, the accountant manually passes an entry, which is closing stock account debit rupees 400 to trading account for COGS adjustment for rupees 400. This moves the value of the unsold stock out of the PL, reducing the expense, and into the balance sheet inventory. Let's see how it looks like in the final PL and balance sheet. So, after the manual adjustment, in the trading account, we have purchases of rupees 1000, closing stock worth rupees 400, and sales worth rupees 700. So, my net COGS would be 1000 minus 400, which is equal to rupees 600. And if I calculate my gross profit, it's going to be 700 minus 600, which is equal to rupees 100. In the balance sheet, we have inventory or closing stock worth rupees 400, trade receivables from the sales worth rupees 700, trade payables from the purchases worth rupees 1000, and the gross profit carried down from the trading account worth rupees 100. So only after the manual closing entry that I had passed at the end of the period, my inventory appears as an asset in the balance sheet and the COGS figure becomes accurate. Now, what's missing? When we were doing the purchases, we had recorded purchases account debit to vendors account credit. This means I have an immediate GL impact and the PL is also hit immediately. However, no inventory asset recognition is there. Similarly, when we were recording the sales transaction, we recorded the customer account as debited and the sales account as credited. The revenue is recognized. However, no corresponding cost is recognized and the inventory is also not reduced accordingly. Coming to the transactions at the end of the period, we manually calculated the COGS adjustment. Although the closing stock is capitalized, since it is a manual entry, there is a possibility that there could be errors or it could be delayed. Now, how COGS is automatically calculated and posted in BC? So when it comes to Business Central uses a perpetual inventory system, meaning every inventory movement in or out is monitored by the system in real time. The system continuously maintains correct inventory value, COGS and gross profit. You don't calculate or post COGS manually. It happens automatically at the time of sales invoice or shipment. Let us take the same example as before. We purchase goods worth rupees 1000 from a supplier. We sell goods worth rupees 600 for rupees 700 and our closing stock value is rupees 400. Let's start with the purchase process. Now we have purchased goods worth rupees 1000 from the supplier. As usual, the entry would be purchase account debit rupees 1000 to supplier account credited for rupees 1000. But Business Central does not stop there. It also passes another entry, which is inventory account debit 1000 to direct cost applied account rupees 1000. So if you see here, we can see the impact in our financials after posting the purchase invoice. These are our journal entries. Purchase account debit 1000 to supplier account rupees 1000. Again, inventory account debit rupees 1000 to direct cost applied account rupees 1000. In the profit and loss account or the trading account, we have purchases debit rupees 1000 and direct cost applied credited by rupees 1000. We have the net impact 0 since there is no actual expense yet. In the balance sheet, inventory is debited by rupees 1000, which is an increase in inventory, and trade payable is credited by rupees 1000, which is an increase in trade payable. The inventory account now reflects the stock value. Similarly, the direct cost applied account in the PL offsets the purchase account, keeping the PL clean. Basically, the net effect is an increase in inventory and increase in payables, and the impact on PL is also nullified. So, until the items are sold, the company's profit and loss is not affected. Everything sits as an inventory, which is an asset. Coming to the sales. Now, we are selling a part of the goods purchased worth rupees 600 for rupees 700. When you post the sales invoice, BC performs two simultaneous postings. First is customer account debit rupees 700 to sales account credited by rupees 700, and COGS account debit rupees 600 to inventory account credited by rupees 600. If you see here, we have recognized revenue in the PL for rupees 700. We have reduced inventory by rupees 600, and we have also recognized COGS as an expense in the PL for rupees 600. Let us see the financial impact of both the purchase and the sales together, like a summary of what has happened so far. First, we are going to address the accounts in the balance sheet. We made a purchase of rupees 1000 for which we haven't paid yet. So, we have a credit balance in the vendor account. So, this will reflect as a liability in our balance sheet. We also made a sales for rupees 700 for which we have not received the amount from the customer yet. So, we have a debit balance in the customer account which will be reflected as an asset in the balance sheet. We purchased goods worth rupees 1000, out of which we sold goods worth rupees 600. So, we have a balance of rupees 400 worth stock remaining with us. This will be reflected as inventory in our balance sheet. Now, let's address the PL accounts. We made a purchase of rupees 1000, and then to offset the purchase, we have a direct cost applied account. So, since the purchases are debited, the direct cost applied account is credited. We made a sales worth rupees 700, and we also recorded corresponding COGS worth rupees 600. So, BC automatically adjusts purchases and the direct cost applied accounts during the inventory posting. They cancel each other out because they are only intermediate accounts used to move costs from purchase to inventory. Effectively, after the system finishes all the cost application routines, we have a sales worth rupees 700, we have COGS worth rupees 600, and we have gross profit of rupees 100. Now, the balance sheet shows inventory or closing stock worth rupees 400, trade receivables or accounts receivable worth rupees 700, accounts payable of rupees 1000, and the gross profit which is carried down from the trading and the profit and loss account for rupees 100. So, to conclude, with Business Central, you get real-time gross margin visibility. That means no waiting for closing stock valuations. PL is accurate every day, not just at the month end or the period end. There are no manual stock adjustments or dependency on physical verification to derive COGS. Audit trail is automatically maintained with item ledger entries, value entries, and general ledger entries. That brings us to the end of today's video. If you have any questions or would like us to cover specific scenarios, feel free to share them in the comments. Don't forget to subscribe to our channel for more practical Dynamics 365 insights and stay tuned for the next video in this series. Thank you for watching.